There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
The Software Strategy Midweek session. My name is Steve Vettel. Today is the 22nd of March. If you guys have any problems with viewing my screen, I'm streaming via OBS, please hit me up on Telegram. Otherwise, let's move into the session. So as many of you may have heard, actually, let me just go in and format this. I get asked a lot how I just get to red folder. Really just a matter of just applying the filters. So when you go in and you have the filter shaded out, so you can have everything just showing, this. So if you hadn't heard the news, yesterday Chairman Powell basically, spilled the beans, showed his hand of cards, whatever you want to call it, that, basically we're looking at anywhere between 20 to 50 basis points in the May meeting, possibly sooner, depending on how things sort of play out for the Fed. So no surprise, we're seeing a lot of the sell-off in bond prices, which is lifting yields. Remember, it's always an inverse type of reaction. Purposely, I think it's like maybe somewhat priced in, but if you just take a look at my favorite FinViz, just click on all, move to the daily charts here and the futures, which really just covers all markets. But you get to see all the forward pricing of contracts and always move down to, just see if I can dial this in a little better, the credit space. So U.S. Treasury 30-year, 10-year, 5-2. You can see the prices are continuing to fall, and I think a lot of this has to do, these last 2 days, each of these days represents a single red candle. It has to do with the Fed and how they're letting things play out in this area. But bond prices are continuing to sell off, mortgage rates are continuing to lift, and the price of bond funds are continuing to get down. How does this have an effect on the dollar? Typically, there is different sentiments of prevailing winds, but I always like to look at this dashboard. This is just a basic overview. I would highly suggest, if you have time, maybe more so than a lot of my presentations the last couple of months, I brought a lot of new material into Saturday, so if you haven't seen it, I would definitely listen to it. I'm just talking a lot about risk management, really just boils down to education. And I go into a lot of detail about different types of charting patterns, which I'm not going to really address today. I have very limited time between client meetings, but I did want to at least chime in and talk about what at least our central bank here in the U.S. is looking to do as far as changing rates around, maybe give you a little bit of overview of what I'm kind of seeing. So it seems like I focused a lot on the credit space. And I do that because there's a lot of people out there in the audience that have bond funds in their 401ks and stuff like that. These have already sort of taken it on the chin. I probably will continue to do so as the Fed raises. And really the very simple purpose of understanding that is that if you own a bond and it's paying you if you own a $20,000 bond, it's paying you 1% a year. And they now come out with $20,000 bonds that are paying you 2% a year, right? Dramatic difference, but I want to illustrate the point. Everybody's going to want those other bonds and not yours, right? So consequently, supply demand takes over as a macro market force, and the price goes down at some point. So looking at all the interest that plays out over that period of time, just understand how it make it work. So what's that mean for currencies? I think surprisingly, maybe not as much if you're looking at the chart here. And let me just hit a Control Plus. Let me make this a little easier to see. Get rid of the noise. There we go. Right where you see my crosshairs was our breakout point, right for the dollar, right around this 97.58 area. We zoomed up. There actually was some volume on this and many other pairs of other types. So we know that there was large institutional participation. Other time frame players were stepping in to take us up out of this area into a new upper balance area. So now that we've done that, notice the tests back down against this twice. Remember, each of these candles represents a single day, has led us to essentially a level of support right around 98. What's that tell me? That tells me that more than likely, as we're probably maybe more than 10 days in this upper balance area, we've probably got more time to spend building a new zone up in this area. That would be my hunch at this point. The problem with hunches and forecasting and prognosticators like myself that try to help people understand risk, at least from a dollar perspective, which you can pin action off all the other currencies, is that what if I'm totally wrong, right? And anything can happen with geo events to take us down. Like, giving the example, the war in Ukraine stops, the dollar's going to get crushed, right? As money moves out of safe assets and back into risk. So it's what's called risk on, risk off. So you'd want to understand the dichotomy that is played out, risk on versus risk off, right? What's risk on? Well, anything that's a risky asset now wants to be purchased if everything's calm and it's looking like a positive growth for the economy. When wars are over, it usually, as long as it's not precipitated by a recession, it typically is a booming period of time as growth gets back on pace to replenish, whatever. In the case of the U.S., when a couple of wars were finished, both World War I and World War II, there were very booming times after that, as the country settled back into, building up just basic industries as we were through most of the 1900s, right? So we were on a path to building basic industries, and that wasn't, the case for a good chunk of the 1900s, at least as far as the U.S. is concerned. We had a whole bunch of depressions and recessions and inflationary periods of time in the mid 70s, like we're seeing now, which I certainly hope doesn't play out. But the Fed is well aware of what's going on. I think you should be too, and just understand that it's going to be more costly to purchase everything from mortgage rates to gas, everything else that's bent on that. Go back. Of note, as I brought up Saturday, anything that is traded with the yen, we're really falling off a cliff here. So we go back up and take a weekly look at the comparisons of everything. By the way, for those, I'm not going to touch too on it, but equities, we're seeing some face rips going on. It wouldn't be surprised if we actually went up to new highs and possibly higher, mostly because the vast majority of the market participants out there are bearish, right? That boat is loaded to one side. Typically, something else is going to happen as the market's already priced that in, especially if we get some settlement out in Ukraine, and hopefully they win that war, which I don't think anybody predicted. So maybe we'll get a reprise on some of these bonds that are just going down, 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 as you can see. But looking at the euro, we're stuck in that same holding period now in a much lower range from. Actually, you know what? Let me just go back and this JP watch. Look at that. We haven't. I actually have to go to a monthly chart. Look at that. When was the last time we saw this? So, in my opinion, the absolute edge of the entire cliff, which we haven't seen in basically 2 decades, is right down here, 0.81. And a lot of you guys don't really mess around with it in the end, but this is significant. We're seeing this back down to levels it wasn't at for 7 years. Now, I mean, obviously there's factors of force, right? But of note, any other pair, because of this significant weakness, keep on, we're on a monthly candle here, right? Look how big that monthly candle is. It's not the biggest, right? But there was some tremendous forces in play as far as global. Right here in this 2013, a couple of extraneous events that took place in currencies, but it was mostly just building up to a crescendo of the boom times, at least as far as Japan's concerned. And I'm not going to go too much in detail, but it's just interesting to note somewhere around 0.8. Japanese yen. Take a look at the euro. Weekly chart puts it a little more in perspective. I would say that, by the way, the last time we were even close to par with the US dollar, let's see when that was. Last time we were even close was 2017, dollar for a euro. Last time we were actually at that point was 2003. Keep in mind, this was just the toilet for the euro because the economy took a pretty heavy hit, as you guys may recall. In Europe, was the beginning of the tech boom. But looking at there's no data back, but we essentially weren't. The euro wasn't formed that much earlier. It's 1996, if I'm not mistaken, that it came out as a aggregate currency of the European countries. And then it had a big period of decline and then a huge period of lift as the dollar played out over that same period of time. So peaked as the market peaked. This was a huge run up in the economy and sort of boom times in the US. Then things started getting really ugly around 3, and it was just a huge tech wreck. And the devaluation got tremendous. We could certainly see this in the next correction. This is a tremendous move from 120 all the way down to 72-ish, if I'm not mistaken. Yeah, right in the 73 area we bottomed out in. But as far as, I guess those could make the same argument back then, we are the reserve currency, if you will, of the countries. So it has more strength. To be continued on that thought. Let's take a look at the calendar here this week. So tomorrow, it'll be interesting to see what's this event? I forget. Yes, this presentation has probably mostly already been disseminated into the marketplace, but I guess if there's a Q&A, not the Fed sort of shown their cards to the marketplace, it's beginning to price in how many moves, what magnitude of moves, and some of those other things that are relative to it. So I'd say stay tuned on that. Do note, guys, by the way, for the European folks, a large chunk of our subscribers, clocks forward. Remember, spring forward, fall back. It's always the best way to remember that. What else did I want to note? I covered a lot of this stuff on Saturday. Relative to the EAs and everything going on, this is the dollar I showed on Saturday. It hasn't changed much. We're on a daily chart here. Did want to take a quick peek at the coinage. Talked a lot about this on Saturday, but there's a chart. I really have more to add to it. Just keeping a close eye on things that are just really surprised me. Like, look at the price of Berkshire Hathaway. It's freaking bananas. Now, look, I get it. These guys are overweight and energy and gold and miners and all the stuff, but I mean, just the uncanny ability of two 90-year-old guys just freaking continue to knock it out of the park is just astounding to me. Equally as astounding as, oh, look at this, Shopify, more than cut in half. This and Alibaba, this is the China play, obviously, it could be an issue. I mean, these things are just an absolute value stock territory. Whoever thought they'd see that, right? But it's the same thing that happened to, and almost all these players in China have just gotten absolutely clobbered. But it doesn't mean you run out and start buying it. You're going to let it balance out in base. What if it's just a dead cat bounce, a rally, and then we continue to sell off? But I mean, this thing's lost basically 1,000 points in 5 months, more than half. So for those that didn't believe from a risk standpoint, forget about the security, right? Forget about the instrument of investment that we're looking at and just look at it from a price perspective. It can happen. Risk happens fast. And all of those knuckleheads, right? Hopefully you guys aren't one of them, that were buying down. Every time it would dip, yep, you'd get a rally. But look at these slingshots. I talked a lot about the formation of a slingshot, right? Those first dips and then the rips right back to whatever area of confluence, very low risk short, right? Especially if there's a huge prevailing wind. In this particular case, China's unwillingness to do a whole slew of things, right? That could affect commerce, not just because the funny thing about it is here's COVID, right? Still strong from a COVID run up, just because online purchasing. Shopify is one of the biggest in the world, but it is a China play. So Baba, much more so, but from a wholesale category, can't say that it's 100% the Amazon of China because they deal with a lot of wholesale stuff, but it's fairly decent. And these two cover global payments, commerce, and retailing in the aggregate, in my opinion, maybe to a lesser degree. Shopify. What else am I going to talk about here? Let's take a look at GBP CAD. Go back to a weekly on this. Do a little reset. It doesn't show us much. Let's see if we can zoom this out. For those of you who don't know what this is a neocurrency that they're EA trades. By the way, also I would have mentioned getting caught up on the global update calls. There's been some changes that have taken place in some different areas. I think you guys, if you haven't seen the call, tune in and make sure you get plugged into what some of the changes were. I won't tell you because I'll make you watch the whole global call. Yeah, I think I've covered most of this on Saturday, so I'm not gonna sort of dive into this arena. All right, so let's do this. I'll cut this short so you guys can go watch Saturday if you haven't already seen it. So otherwise, have a great week. If you guys have any questions, I think as always, follow me on Telegram. And you can always hit up our friends and make sure they're following me on the links. Do watch the recordings with your EA developers and myself at the very least each week. It will make you more risk plugged in and more educated on the risk, thus being hopefully more risk averse. And if that's the case, I have done my job. Wish everybody a great week. May the trades be with you.
There is a substantial risk of loss associated with trading Forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.